Today we're going to talk about yesterday's high and low and identifying what type of day today might be. Stay tuned, traders. We'll be right back. Good day, traders. I'm Stacey Burke from Stacey Burke Trading. Non-farm payrolls last night, some big moves in the markets, some great moves on a lot of different cross rates this week. A lot of great feedback from traders, a lot of questions, a lot of emails. So thank you again for being patient and just gradually working my way through trying to answer everybody's questions and emails. And again, thank you for hitting the like button. Today we're going to go and review yesterday's high and low, the significance of that. We're going to talk about the three things that markets do and using that to identify possible high probability trade opportunities. So I keep talking about building your best trade playbook setups. And I've had some questions about what are those best playbook type trade setups. Well, the way that I identify those are the days that it's easy to make. You want to make money on the days that it's easy to make money. Now, as you've found, trying to trade every move in the market can be challenging, and that's where a lot of the problems lie, is that when you try to start trading every move in the market, you get beat up, you get chopped up, you get some winners, you get elated, the next day you get beat up, you get depressed, you're up and down like a yo-yo, you say it doesn't work, and then you jump to a new system. It's really important as a retail trader to try and step back and take the amount of trades and narrow it down to a really small window. We talk about narrowing everything down to the simplest of steps. And today we're gonna do that with a big picture scenario and narrowing that down with a couple of simple things. I answered a few questions for some people that just really simplified some things and how I try to approach the market each day, so that I'm not trying to trade every move, but I'm just looking as the market unfolds for the best opportunities, where when we position ourselves in the market, there's very little stress about being in that trade. And you know what I'm talking about. Those are the trades that when they move, you're in profit almost right away. They move quickly. You have your 50 or 100 pips and you think to yourself, wow, how easy was that? And then the next day you end up trying to trade a market from the high or the low, and you get chopped up, or you get stopped out, or you try to counter trend it and it hits you again. We don't want to do that. What we're trying to do is step back and let the market tell us what it's trying to do, and then position ourselves in the direction of that move. Once they've done their work and they're done being down at that level or up at that level, and they're going to move the market, whether it's with a trend or whether it's a counter trend trade. But today we're going to talk about how to possibly identify the best opportunities based on using yesterday's highs and lows. So we talk about the three things that markets do. Now we're going to go through each one of these, and then I'm going to show some examples on the charts from this week of pairs that would fit into these categories, and how we can use yesterday's high and low to help us determine potentially what type of day we may be in as we head into the next session, whether that's London or whether that's New York. And in some cases, it could be Asia as well. So the first thing that markets do is they break out. Now, in a large majority of cases, most breakouts will fail. But when they break out and pull back and they trend, those can be explosive, huge moves. Now, in the big picture, realistically, we are trend traders. We want to be trading with the trend of the smart money. So let's take a look at some of those examples.
An example, traders, of a market trading inside of the previous day's high in the Asian session before breaking out into the Europe London 12 candle window. 1, 2, 3 at the London Open, sideways, double inside bar, pin hammer in the third hour for a 50 pip move back down, but we have a breakout, pullback, 1 push, 2 pushes, 3 pushes, consolidation, pin hammer, and a reversal into payrolls for a measured move back through the high of the London Open. But just an example again of breaking through the previous day's high, breakout, pullback, 3 pushes down into the previous day's high, sideways consolidation, pin hammer, and a measured move back with the original trend. Another example of a trending day. Market trades sideways and then breaks out in the Asian session through the previous day's high, pulling back and then working down with 3 pushes into the current low of the Asian swing low, and then breaking out again. So breakout, pullback, continuation into the Europe Open, taking out the Asian high, moving up another 50 pips. Breakout, pullback, engulfment, pin hammer for the continuation back through the high of the Europe Open. And again, breakout, pullback, engulfment for a continuation into the US session. Breakout, pullback, continuation, example of a trending day.
Okay, so we've looked at the trend trade setups. Now let's take a look at the next one. Markets will break out, or they'll hit the stop, they'll hit the high, or they'll hit the low, taking out the high or taking out the low, and then they'll pull back and reverse. And in most cases go to the other side of the market to either continue a trend or to hit the stops on the other extreme of those highs and lows, and we call those false breaks. Colin Nicholson used to tell me they're not false breaks because they broke out, they're marginal new highs and marginal new lows. But for simplicity's sake, we'll call those false break reversal trades. So let's take a look at some of those now from this week.
An example of the market trading sideways in Asia into the Europe-London Open in between the previous day's high and low, which is the blue line. 3 pushes down, pulling back, and then 1, 2, 3, breaking through the previous day's low, and then pulling back with an inside bar, and breakouts, consolidation, and an engulfment in that second hour in our 12 candle window at the last candle of the second hour for a reversal back towards the previous day's high. So breakout, pullback, false break, reversal, taking out the high of the day and continuing on to the previous day's high. Breakout, pullback, false break, reversal. An example of the market breaking out in Asia before going into consolidation as we head into our Europe London 12 candle window. Market makes 3 pushes down, 1 push, 2 push, and then a 1, 2, 3 engulfment reversal shift candle, and then breaks back inside of the previous day's trading range, and then going down 1, 2, sideways 3 pin hammer for a move back through the high of the day. Breakout, pullback, so a false break reversal after a consolidation, and then a breakout pullback in the Europe London Open with pin hammer for a move back through the high of the day. False break reversal just over an extended trading range. Market moved down, went into consolidation, 3 pushes to the low, 1, 2, 3 on the third push, shift candle, breaks back inside of the box, stop hunts traders who are long before reversing and continuing back through the high of the day. An example again on a Monday, market opens on a gap through Friday's low before pulling back just prior to the Asian session beginning. Retests one more time before pulling back and consolidating sideways in the Asian session. 1 push, 2 pushes, 3 pushes down, and a shift candle again. Breaking out in the Europe-London session. 1 push, 2 pushes, and then a third push back through the breakout pullback. Pin hammer at the first candle of the 4th hour after our 12 candle window. So again, that hourly rotation, but we have a false break reversal, consolidation, and then a move back towards the other side of the trading range, which in this case was over 100 pips away. So false break, reversal, consolidation, and a reversal of the trend in the opposite direction. Another example of a false break, right at the beginning of the Asian session, the market breaks through the previous day's high before reversing and engulfing the breakout candles, consolidating, and then continuing the move back down towards the low of the day. So it broke out of the previous day's high, blue line, drops down, consolidates, And then in the Europe Open, 1, 2, 3, hits stops at the low of the day before pulling back. 1 push, 2 pushes, 1, 2, 3, and continuing the move down back towards the previous day's low. So false break reversal takes out the current low of the day before continuing that trend in the opposite direction, taking out the previous day's low. False break reversal.
Okay, so let's look at our third criteria, a market that breaks a previous day's high or low, pulls back, and then goes into a trading range. Now we see this a lot sometimes at the end of a session when it consolidates into the close, but we'll often see that on low ranging days where it may hit an extreme, but it stays range bound and it typically just trades sideways. Let's take a look at some of those.
So an example of a day where we have not taken out a previous day's high or low, but we've actually gone into a trading range. And whenever we go into a trading range, we want to make sure that we trade off of the highs and the lows. And the purpose of this is obviously to keep us out of possibly choppy markets or a range-bound market. We want to have at least 50 pips minimum from high to low. If we're going to be risking 15 to 20 pips on a one-bar stop, we want to be targeting at least 3 or 4 times our risk. And again, we can see this market push down, went sideways in Asia. 1 push, 2 pushes, and then a 1, 2, 3 pin just prior to the end of the session, and then a 1, 2, 3 back down against the breakout of the consolidation. The market then moved back towards the high of the trading range before dropping down, consolidating, and hitting stops on the breakout traders down low, and then moving up in 3 pushes, 1 push, 2 push, 3 pushes into the US Open, an engulfment selling high in the trading range for a move back down and a measured move breaking through the trading range. But just an example again of a market that has gone into a trading range. Hadn't taken out either previous day's high or low, stayed in the trading range until the US session.
Okay, so we've looked at the 3 things that markets do. Now that essentially is all that markets do. So if we can narrow our window down even more now to try and avoid maybe low ranging days or days that haven't yet broken out of an extreme, we want to just look again at our next few steps. So we're just going to sort of simplify this a bit more. We're going to take a little bit out just to keep it really simple. We work from the high and the low of the day. Now I know a lot of traders have been trying to trade all the moves inside of the current day's high and low. Now ideally, one of the things that I like to look for right away is whether or not the previous day's high or low has been broken. Because typically, I like to see a market that's possibly broken out and trading around that extreme for a continuation move, or in some cases at the low or the high of a week for a reversal day that will come off of the extreme. But generally speaking, the best days that I try to look for are the trending days, the ones that have already broken out of the high or low, and they are pulling back or bringing us higher or lower into the London Open and sometimes New York for a reversal trade with the trend. So often if we're caught in a low ranging day, that typically can become an inside day or a day that's possibly just working maybe around the extremes, but it doesn't have the breakout that we want to see. Remember what I said in the beginning. We want to try and make money on the days that it's easy to make money. There was a couple of setups yesterday and earlier this week on the pound yen, the pound Swiss, and on some of the euro cross pairs for some fantastic trades that just kept going. They would pull back and keep going, and those are the days that you definitely don't want to counter trend the trend. So the next thing we talk about is the timings, the importance of that 12 candle window. Now, as I've reiterated, there are often trades that will come in that gap time in between, in that 3-hour window prior to the session. But in a lot of cases, what you'll find is that it will be a market that's broken out and they've either worked into the low for a continuation, back with the trend. So again, we'll get 1 push, 2 push, 3 pushes and a shift candle, maybe a pin hammer, inside of that gap window for a breakout pullback where a stop hunt back into the trend in that US Open or London Open for a continuation. And the same thing can go on the downside. A market may be trading inside of the high and low. It works to the high, works to the low, pulls back, and keeps working and breaking its way out. We get to the bottom and it pushes in 3 times and shifts in that gap window, works back into the low for a continuation back up towards the high of the day and possibly the previous day's high. So again, sometimes you'll catch traders, other time frame traders entering the markets, bigger traders, institutional money, end of day traders. They trade the breakout of those extremes, and if there's no follow through, that market will pull back inside and in some cases retest the other extreme. It'll first go to the current high or low of the current day and then test the previous extreme from the previous day's high or low. Remember what we talked about, you're inside of a box. They trap the volume inside, they catch people trying to chase the breakouts. If the market doesn't follow through on that breakout, pulls back, and it will often go back to the other side because that's where those stop losses are placed. If it breaks the previous day's low and pulls back, it'll be the most current day's high. If they continue the move, it'll go back through to the previous day's high. Those are the most obvious areas for larger pools of liquidity to build up. Now, with the timings, I also identified that in a large majority of the cases, the last candle of an hour and the first candle of an hour will often be the entries into those moves. And for a number of reasons, I'm sure, but if you just think about the hourly rotation, we talked about 915, the 4-hour, the 1-hour, and the 15-minute rotation of those all coinciding at the same time may be providing fuel for that move. But if you're paying attention, that narrows our 12 candle window down potentially to 6 or 7 candles. So we've now cut that even closer to the first and last candle, and even the last candle prior to the 12 candle window opening. So the hourly rotation is important. Now the next thing we talk about are engulfments and pin hammers. People keep saying, when do you get in? I keep showing this on the charts, and if we've just narrowed that down to 6 or 7 candles, you can then identify when there's been a trend move that's jammed into 3 pushes and reverse. There's an engulfment and a pin hammer in a lot of cases together. In other cases, if it's a trend trade, you'll get a 1, 2, 3 and a reversal with an engulfment and a continuation. And again, in some cases, you'll get an engulfment and a pin hammer in the direction of the trend. In a lot of cases, you will get a pin hammer as the first candle of an hour that starts the move. So when you tile this together and you're looking for a break of yesterday's high and low, that can help us identify, is this possibly a breakout pullback trending day? Is it a breakout pullback false break reversal? So we may be trading to the other side with the trend. Is it a breakout pullback trading range just going up and down from high to low? So you can get a false break reversal that's now trending in the other direction. You can get a breakout pullback continuation that's trending in the direction of the overall market trend. Very important. Then the timings. We have the 12 candle window, and then even narrowing that down to the last and first candles of the hours in that rotation. We know that a lot of those trades and movements are coming off of round numbers. And also, we're not going to go too into depth of that, but the 100 pip boxes. Hourly rotation, and the next engulfments and pin hammers. We're keeping it simple. Obviously, we could add a 6th category in there, and we could talk about risk reward. We want to be targeting 50 or more pips. Obviously, if the market hits a daily high or daily low, the market can fail there. So you need to be prepared if it doesn't get to the 50 to take off money or move your stop to break even. But if the market clears that and continues in a trend trade, for example, now you could be targeting 75, 100, 150 pip movement for a market that's continuing strongly in the direction of that trend. So hopefully that makes sense, but I want to reinforce it's really important each day to come to the screen and just look, filter out some of the poor quality pairs that maybe they're narrow ranging or they haven't moved yet. Look for days that have already shown some kind of explosive movement. They've triggered other time frame traders into the market. That attracts more money possibly behind a move to continue later, or a move that may fail in reverse, trapping traders on the wrong side to go back to the other side from the previous day's high or low. Stay disciplined, traders. Keep it simple. Identify what type of day it may be today. Stick to the basics. Keep it simple. Keep getting better, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.